In venture, you're making a lot of risky investments. You only need 1 or 2 investments out of 20, 30, 40, or even 50 investments that are going to return the entirety of the fund. Time spent on winners is typically better spent than additional time on losers. You need to play where you have a fundamental right to win. A GP stake investment is really a perpetual investment in the investment company. It's not like private equity or real estate where you plan on a buyout in 5 years, or a venture where you plan on a Series C round funding coming in and a liquidation event or an IPO. Other funds call their GP stakes lines strategic capital holding. And I think that's a very appropriate name. Now, we're a little different because the majority of our investment is essentially collateralized by the investment strategy of the funds that we're partnering with. We can have a term dated fund. Still, like, my goal for investors is to basically create a perpetual dividend, if you will. Yes, I think I can generate a return plus interest within our 10-year mandate. But for me, there's no exit there, right? We'll receive our principal payback plus interest based on the underlying assets in those portfolios. For the GP stake, look, I want to partner with these firms in perpetuity and in the long term. I want to focus on those that are great and help them build truly robust asset management firms. There are basically 3 firms in the world that own, 95% of the assets. The fund ecosystem is really interesting right now. You've got these behemoth firms. You have Blackstone that just succeeded $1 trillion in private assets. Like, are you kidding me? Like, that is wild. And then you have also simultaneously, we have the highest number of new emerging funds ever before recorded. I want to, for the reasons I cited earlier, I'm focused on empowering the little guys and making sure that there's a level playing field on Wall Street and that there are multiple asset management firms that are managing investor money. Look, I was at a dinner in New York the other week, and we were talking about who has the right to earn money. And it was the former chief risk officer at Lazard I was kind of in a heated debate with. And he was talking about, like, look, people don't have the right to manage money. And I said, bullshit. Listen, he was talking about how you have to work 20 years and, refine your mandate. He was talking about the traditional route to a fund manager, right? That you need to be an analyst. You need to get a Harvard MBA. You've got to go work, decades, and then you can go spin out your firm. And I asked him, and this was at a whole dinner. So me and him were kind of monopolizing the conversation for a little while. But I said, listen, you're telling me that somebody that works really hard in something, they make some money, and they start putting their own dollars to work in some investment. That's real estate, venture, hedge fund, whatever it is. And they generate a return and they are creating wealth for themselves. You're telling me that they should not be able to generate wealth for others? They should not be allowed to take on other investment dollars? I was like, look, there's the traditional route to Wall Street and there's the untraditional route. That guy that's worked on Wall Street for 20 years, he's probably only seen a small piece of the business. And yeah, he's really good at that piece of the business. Don't mind me. He's really good at underwriting deals. Like, he is phenomenal. But has that guy ever ran a business before? No. Has that guy ever put his own money to work on one of his investments? No. He's always acted on behalf of somebody else. Look, I think, and it's unconventional, but I think every person that is able to put their own capital at risk, generate a return, has every right to do the same thing for others. And if not more so, I would rather work with that guy because they know how to deal with all the shit, right? In running a business. They know how to work with people and investors and problems. And those are the managers that I'm looking to back and empower and help become institutional grade managers. I think it's good to do regular time audits. I think this goes back to goal setting. So I have this practice with my partners. Before getting into business together, I had every partner allocate, hey, what percent of our time should be spent on which part of the business? In retrospect, where have we allocated our time? I think it's about knowing where your barriers are. Because I think you can always put too much time into something, but you need to be intentful. I'm a big fan of EOS, the entrepreneur operating systems, the framework, right? Essentially, if you're not familiar, one of the biggest principles in the EOS framework is if you had sand, water, pebbles, and rocks, if you were to fill up a jar of, which is your capacity, if you do the little things first and then do the rock, like, you're not going to have any room for the rocks last as you fill it up. If you flip it around and you do the rocks first, then the pebbles, and then the sand, and then the water, your capacity of what you can fit it goes up exponentially. And so, I'm a big advocate for, hey, know what your rocks are. Right? Know what, and what I mean by rocks are those key deliverables, right? Those key, if I don't do anything else today, what do I need to get done? If I don't do anything else this quarter, what am I going to get done? And so I think if you can hold yourself accountable to completing rocks and driving value, that's going to help you win in the long term. Now, as it specifically relates to GP stakes and time management, there is unfortunately a time in most investments where it's the Pareto principle. The Pareto principle basically represents that 20% of your inputs are going to be responsible for 80% of the outputs. So your top 20% is going to generate 80% of the profits in your business. And the bottom 80% is only going to be responsible for 20% of the outputs. And so it is with time, with investments on that top 20% that is going to generate 80% of the output. And I think it's the same principle in business with these funds I work with. At the end of the day, there's some funds that, fortunately we haven't had too many like this. But again, before the fund, and some of these ones that I worked with just on a one-off basis, where you just got to draw the line and say, hey, look, this isn't going to work. Right? You got to know when there's a loss investment. In venture, you're making a lot of risky investments, right? And there's a high probability of failure. And so you need to go and invest in a large number of investments. And in reality, you only need one or two investments out of 20, 30, 40, or even 50 investments that are going to return the entirety of the fund. At the end of the day, statistically, one or two companies are going to return the majority of the capital in a venture fund. And that's demonstrating the power law, which I think is an exaggeration of the Pareto principle. So basically, you need to identify your winners and double down on your winners and make sure, like, time spent on winners is typically better spent than additional time on losers. I don't know if there's a rule for that of how much is, I don't know if there's a formula I have yet. It's more intuition now at this point, where you just got to know that, look, you've invested some time, it's a sunk cost, and I need to focus on managers that are actually building momentum. I trust my gut a lot, honestly. I usually have pretty good intuition about things. And sometimes I think I need to listen to my gut more, to be honest. I'm a very analytical thinker, and sometimes I'll let the analysis portion overweigh or negotiate with what I feel deep down. And I've made poor business decisions in the past, even with, partners that I've worked with, where my initial gut told me no, but I let outside opinions and other things sway me. I ultimately regretted it, right? It's a lot easier if you don't have to deal with those types of problems. I don't like to apply that in investing. I think at the end of the day, there's discretionary investing and there's disciplined investing. I want to be and try to be a disciplined investor where I have methodically thought through what could go wrong and how to mitigate that. And I think the reason that drives me to be more of a disciplined investor is too many mentors, too many other individuals that are more seasoned in this industry than I am that have said, listen, I decided to go with my gut on something and it was outside of my wheelhouse. It was outside of what my mandate was and it didn't work out. And I wish I never would have stepped outside of my zone, right? Like I think investors and business owners, you need to play where you have a fundamental right to win. Warren Buffett talks about, a competitive moat in business, right? Where that's really what makes a business win. Peter Thiel calls it, you need to operate in what you think you can have a monopoly in, that you can be the only, outsized returner. And there's a bunch of other businessmen that talk about, like, really at the end of the day, it's like, you need to play where you have alpha, where you have an edge and what I call a fundamental right to win, where the chips are stacked in your favor. We're playing chess, except I start with 5 more people than you do, right? We're playing a game of basketball, except it's 5-on-3, right? I want investments where we have a fundamental right to win. The odds are stacked in our favor to have a positive outcome. And I think the only way to do that is to be disciplined and, extremely disciplined investor. In maybe the quantitative things, I think I need to listen to my gut, but in investing and other managers and other investors, I think it's far better to be disciplined and systematic in your decision making. That's going to drive more consistent results at the end of the day. That's a big thing that managers need to define and I look for in their investment thesis, and I underwrite for that. You just got to assume that there are 20 other lookalikes that, you're handing in your deck to someone, or you're pitching someone on a business idea. And you have to assume that there is somebody with the exact same experience as you, with the exact same kind of idea or concept. But why are you going to perform better than somebody else? And investing, that's really what it comes down to. There are 3 types of alpha in the world. There's analytical alpha, there's informational alpha, and there's behavioral alpha. Where does your alpha derive from? Do you think that you behave better than others, right? Kind of the gut conversation we were talking about. Do you think that you're able to just make better decisions based off emotional? Do you think you have better information than other individuals? Are you better at analyzing the information available? For us, like, we think that we have a proprietary, source of deal flow for our fund. And that's what it clearly demonstrates our alpha, right? It's hard, that we have a proprietary source of deal flow. Like, that's hard for somebody who looks exactly like us to beat out, that's doing GP stake. So I'd encourage other managers, whether that's in venture, private equity, or any of the other alternative asset classes, define your edge and make sure that you have one.